everyone, and a very warm welcome. There has been a lot of action in the Indian mutual fund industry, with new entrants keeping pace with established players. Among them, one name that has carved a distinct identity for itself by defining investing as both an art and a science is White Oak Capital Management. To understand more about their philosophy and approach, we are joined in today by Mr. Ramesh Mantri. Mr. Mantri is the co-founder and the chief investment officer at White Oak. With over 2 decades of experience across asset classes, both in India and globally, he is an epitome of wisdom and knowledge in investing. He's a CFA charter holder, a chartered accountant, and an alumnus of FMS Delhi. Thank you, sir, for joining in and your time today.
Thank you, Megha.
So, sir, let's dive in straight. What is the story behind Vito Capital Management? What led to its genesis? And how do you differentiate yourselves from the other 50 players that already exist?
This Vito Capital Management was formed in 2017 by Prashant Khimka and a number of team members, including me. And so, Prashant was 17 years with Goldman Sachs, had managed money in the US market, managed India fund for over 10 years, and also been the CIO for Goldman Emerging Market Strategies. So since he had invested globally, even myself had invested not only in India but also outside India, and other team members, my colleagues also have dual experience of investing not only in India but also we said this first an opportunity to start an investment management firm, first out of India because that's our home ground. But the ambition or the will on day one, and I'm going back 2017 when we had zero AUM, is to build a global asset management firm out of India. The key word is global asset management firm and out of India. It looked very ambitious in 17 when we started because when you start from zero, it looks like a very ambitious goal. But we have spent now 8 years doing this, I think we're on the path to building one.
Sir, I'd just like to kind of dig deeper into how a new AMC positions itself because, what we understand is that, when you start late, when you enter the market late, there's a lot to learn from your predecessors. And it kind of also helps in designing your investment frameworks. But in an industry where a long-term track record, performance, vintage, etc., holds so much importance. Does it become a challenge or does it offer actually an advantage?
My observation is the first mover advantage is often overvalued. Now, if you look at globally, a lot of companies across the world, right, including internet, where people believe that first mover advantage is everything, right? Think of Google. Was it the first search engine? Think of Facebook. Was it the first social media platform? Right. So, in fact, I would say that often it's better to start late because one, the market development happens. You don't make a lot of mistakes. You have to, you already learned a lot, and then you can offer a better product. So, and I would give credit to all our predecessors, all our peers in the MF industry in India for the last 30 years. They have built the concept, the cult of mutual funds in India. They have sold the concept of mutual funds. For us, we no longer need to tell what people mutual funds are. We just need to offer a better product. And you came on the second question on whether track record and all those things matter. I think track records all matter all the time. But question is which track record, right? And I think that's very important because see, while we started the mutual fund AMC 3 years ago, remember we have all have the team has number of team members have more than 15 years experience, including me who have more than 20 years experience. So the question I would ask you is, let's say if you're setting up a new IPL team and your option to hire Bumrah, do you say I won't take Bumrah because Bumrah has not played in our team, or you're going to look at the previous track record of Bumrah across, in his career and say this is a great player, I want him in my team. So I think we have as professionals, as I said, the founder Prashant had run a Goldman India fund for 10 years. White Oak, even before we started the mutual fund, have been running PMS and AIF for the last 8 years. So we all have track records. It's just that the track record doesn't exist within that legal structure. But then I would say just because Bumrah plays for a new team does not mean that the previous track record is irrelevant. In fact, that is exactly what matters.
I think that's very true because the more time you spend in the market, the more humble you become. And I think it always has, every cycle has so much to offer in terms of learning. So, sir, speaking specifically about the White Oak FlexiCap Fund, could you help us understand the investment processes, your coverage universe, and how the research team works behind the fund's decision making? And how do you distinguish your FlexiCap fund from the other 25, 26 funds that exist?
So that's a lot of questions in one question, right? That's going to be a, I would say, essay answer, right? So rather than asking, you moved quickly from T20 to test matches, right? So first, see, the philosophy is fundamentally the philosophy of investing is to invest in great businesses, attractive valuations. And it would seem like very simple. It sounds too simple, the philosophy of White Oak. But one of the misnomers about investing is philosophies need to be different, and our views they don't need to be. I'll give a very different example which everyone can easily relate here. Like what you need to do for good health. Good health. Fundamentally four things: eat well, exercise, sleep well, live a stress-free life. By the way, we've known these answers for thousands of years. You can refer to even Ayurveda. So the challenge of good health is not knowing what you need to do for good health, is every day implementing the tenets of good health. So similarly, investing is not about a different philosophy, but a disciplined implementation of your investment philosophy. One of our core aspects of our philosophy is we don't spend time thinking about macro things like interest rates, currencies, commodities, what US will do, what Russia will do, what will happen to oil prices or gold prices, or the Federal Reserve policy or RBI. Now, a lot of people think they are super important. Yes, we agree they're important. They're as important as a toss in a cricket match. Does a toss in a cricket match matter? The answer is yes. But can a cricket captain do something about the toss? Can he practice a lot more tosses and say, I want to increase the odds of winning the toss? So let me practice the toss or spend time practicing the game. So we are very clear. We don't spend time on macro while it matters, but nobody can benefit from it. We're entirely bottom up investors. The whole idea is a bottom up research. And to do bottom up research and have one of the largest coverages of stocks in the Indian market, we would say Avito probably has one of the largest coverage of stocks in India, about 1,000 stocks in the Indian market. And for that, you require a large and a deep experienced team. That is the single best story or positioning we have. The biggest investment research we have made for any asset management firm in India in the recent years. And the process is very simple. Spend a lot of time on the ground, talk to companies, talk to their competition, talk to customers, talk to vendors, talk to trade partners, talk to regulators, industry experts, ex-employees, ex-CEOs, ex-CFOs, to fundamentally understand three things. First, understand the business, the quality of the business. Number two, to understand the execution DNA or focus of the promoter and the management. And number three, to understand corporate governance practices. Corporate governance is a very sophisticated word. It's simply to understand whether the management or the promoters are crooks or they are your business partners. A very simple framework. And the team does over 3,000 meetings a year, doing this on the ground. We spend extensive time visiting companies on ground.
So, sir, I think what you broadly mentioned is, operate within your circle of control. And I think that holds true irrespective of whether it is investing or, any other thing that you choose to do. But sometimes, there is often a narrative which, flows around in the market which says that younger fund houses do not have access to the management companies or the investee companies. You've highlighted in our previous discussions as well that, how do you go about corporate governance checks? So, for the benefit of our investors, could you share some examples? How do you implement it on a day to day basis?
Idea that that younger fund houses don't have access to management, I think is flawed. In fact, I would say when you are a very large AMC, you tend to focus on larger companies. So you don't even spend time on smaller companies. And let me get back to the same point that while we are new on the mutual fund side, the firm has been around for 8 years, the group manages over $9 billion in India. And for example, even like someone like me has more than 20 years experience. So we all have our relationships and networks. We've been tracking the same companies. I would say we, in terms of access, we are second to nobody. In fact, would be better than a lot of, even our larger peers. And one of the demonstration of that is just look at the high quality IPOs that have happened in the last 3 years in India. How many of them where White Oak has been the anchor investor, right? If some of the most blue chip IPOs that have happened or greatest IPOs have happened last 3 years, if we have been a top anchor, that tells you the quality of access we have. Not only access to management, but the fact that we are considered a preferred partner by some of the best companies when they allocate from the anchor book.
So, we have understood about the philosophy of the fund house. Now, I would want to draw the attention toward how to track the performance. Now, when you speak to fund managers and when they speak to investors, most of the time they talk about performance or alpha, which they would have generated. But what we have seen is you often talk about the concept of information ratio. Now, there are two questions here. One, uh, for our investors who would not be well versed with this concept, what is this concept? And if you could explain in layman terms, and what is the importance of this versus, say, a return or an alpha? And second thing, what is the target number which you have for information ratio, and what do you do to achieve that number?
So, first of all, see, often when people talk about performance, you talk about alpha. Alpha is beating the benchmarks. As an active manager, our first duty is to outperform the market. Otherwise, we are not adding value. Then, second thing that matters is how consistently you do that. And information ratio is a measure of one, the amount of alpha you create, and the consistency of alpha. Globally, this is the gold standard in evaluating active managers. When we talk to our international clients, the first number they look at us before even they evaluate us is what is our information ratio. This number is now considered so critical that even SEBI has mandated from this year that AMCs start publishing this for all the equity schemes. In fact, it's published by an independent agency so that it's calculated on the same approach for all the schemes in the market. Now, let me explain this in a very simple language what fundamentally is. Let's say, I'll continue the analogy of cricket players. So let's say there are two cricket players, both an average of 15 test cricket. By the way, an average of 15 test cricket is considered brilliant. Tendulkar had an average of 53. So now 50 average you can get in two ways. First is the first innings you hit 100, and the second innings you go for a duck, right? Your average is 50. Other way to score a 50 is to hit a 60 in the first innings and a 40 in the second innings. Your average is 50. Now, it's the same average mathematically, but the experience is very different. Like, for example, when you're starting with the first player, you don't know whether a century is coming or is going out for duck. While when you have the second player, you're assured that a certain amount of runs will get scored. So fundamentally, not only is measuring that average, but the consistency of scoring that average. And because we are talking to a firm from Bangalore, one of the most consistent cricketers in Test cricket was Rahul Dravid, who comes from Bangalore. And the greatness of Rahul Dravid was his consistency. So that's what we're trying to do. Information ratio measures both the level of performance and the consistency of performance.
So you're trying to mix Sehwag and Dravid together. That's what I could understand from this.
True, true. And in terms of what ratio is good, so let me explain this number because So first, this number has to be positive. If the number is negative, that means the fund manager is not creating value. Up to zero point 0.5, you are creating alpha, but you're inconsistent. 0.5 to 0.75 is good. 0.75 to 1 is very good. And if you are above 1, it is excellent. Now, obviously, the aspiration is to be always above 1. But let's understand, but at least I think over time we should be able to deliver over 0.75, which is very good.
So next, I come to a question which you discussed, but we couldn't touch base in detail. That's about corporate governance. Now, there are all kinds of investors. So we see often a lot of DIY retail investors who think that they can read the balance sheet and they can invest in the companies, but often corporate governance part is ignored. Now, my first question: how or what are the key triggers or key signals which retail investors end up missing and active managers end up capturing as far as corporate governance is concerned? And what are the few risks which at your end you try to mitigate?
Yeah, so let's say a very simple idea. I said like among the three things we check, one of the most important thing is corporate governance when we do our entire diligence. Fundamentally, if a business makes money, but if the promoter is not aligned with you, then you are unlikely to have a good outcome, even if the business makes a lot of money. So that's the fundamental construct that you can't be well off by partnering with a chore, very simple crook. So now corporate governance failures occur in various shades, various varieties. First is when companies siphon off value, right? Which means, values transferred from the company through, paying to promoters entities, fake invoices, another business that the promoter runs, which is in conflict with the listed company, right? When they create and when they get into an exciting business which has been developed by the listed company, the promoter owns a large stake in that business. It can be a variety of ways you steal value. The second is when you misrepresent or manipulate the stock. So, you report wrong numbers, you manipulate the stock, you give wrong guidance, you misguide the investors, you partner with the wrong kind of people to manage the stock, particularly before a capital raise. The third kind of failure is when the business fundamentally operates through illegal or corrupt business practices. Often happens in India in where government is involved or in sectors like real estate, when the business is not kosher. Another kind of failure, of course, is when the business is not run for the benefit of shareholders. It's like run as a family enterprise where everyone in the family works whether they're competent or not, and it exists to benefit the family and not all the investors. And finally, the classical thing that is very common is when financial statements are misrepresented, aggressive accounting happens, variety of ways of aggressive accounting. Now, what we have done is we have invested in a one in-house dedicated forensics team just to identify corporate governance failures. Now, the team, of course, studies the financial statements in detail, not only of the listed companies, but also the private businesses of the promoters in what business they are, including their family, what businesses they are in. We also look at the historical track record of the promoter, past cases, whether even if a case was 20 years ago, whether they have been on the wrong side of regulations, whether they've had a SEBI order against them or a regulatory order against them. So there's a lot of work that does to arrive at a conclusion whether everything is clean or not. It's a lot of, I would say, hard work, where your job is not to identify a great idea, but actually to figure out where not to invest in. I think that's a great capability the firm has. And I think it helps us to create alpha by avoiding the rotten apples in the market.
So what I could understand is that being a CIO or a fund manager is not just about understanding pure finance, but also about, having a trait of being a detective or being investigative on a lighter note. So, my
True.
next question is about something which you are very passionate about. Whenever we listen to you, you always talk about active fund management. But we are
Yes.
also seeing a trend of passive, and this is also linked to my previous question where I was mentioning about DIY investing. So, where do you see the growth of mutual fund industry coming in next decade or so? Because you are also relatively young and you would have your internal benchmarks for growth, but you are not a believer in passive as a fund house. So, how do you see the growth coming?
First, when you look at, mutual fund assets to GDP, we are in the mid-teens today. Can we get to more than 50% in the next 15, 20 years of GDP? The answer is yes. And remind you, the GDP itself is growing at 10 to 12, 11 to 12%. So can the mutual fund industry grow at high teens for a very long period? The answer is yes. So first, the market opportunity is very large. We are seeing, particularly post the demon, significant financialization of savings, right? And so that's a mega trend in India. People are moving from just investing only in gold, bank deposits, or uh, you know, real estate to more productive financial investments. So that's a mega trend. So one, the market is very large. Number two, active versus passive. I think, first of all, because the market is very large, we should not focus on this. I think the role is very clear that we are trying to compare in see the problem of finance is we look up to US for all examples because US is the most evolved market. But please understand, in terms of evolution of, let's say, mutual fund industry itself, US is probably 35 years ahead of India. So should you try to learn from someone who's 35 years ahead of you, or try to learn from someone who's 5 to 10 years ahead of you? I think that should be the right metric. So the problem is we're trying to take analogies or lessons for people who are too far ahead of us, right? And you realize that many of those models don't work in India, right? Like, for example, people tried the quick commerce business model in US. It did not work. But we know now it's working in India. So things that are going to work in India, will it work 35 years later in India, quick commerce? The answer is probably no. But can it work for the next 20 years? The answer is yes, right? So you have to be context where you compare with. So the right comparison should be countries which are 5 to 10 years ahead of India in terms of per capita income. And there, clearly, there's a very large potential for active managers. In America, the number of listed companies have been shrinking for last 20 years. In India, we have practically multiple IPOs per week. Because see, there already the risk capital existed. In India, capital markets still provide risk capital to entrepreneurs. So very different stories of evolution. And that's why we believe there's a very large potential for active management in India. I'm sure the passives will also grow because people are going to, there's always going to be a part of the market that wants to innovate, do different things. So passive will also grow, but I think the opportunity in active is very large for us to even start worrying about passive.
And then just to add to what you were mentioning about number of stocks shrinking in US, I was reading that today the number of ETFs in US is higher than the number of stocks which are listed. So for last 5 years, the trend is investors moving to advisors to figure out which ETF to invest in. So that's again a dimension,
So,
with
so
respect to active versus passive.
let me just remind you, we have just more than 1,000 mutual fund schemes already in India. And will that number be over 2,000 in 3 years? The answer is probably yes. So then you need someone to advise which mutual fund scheme to invest in.
Taking this discussion further now, and the reason why I'm asking this question is for our investors to understand, uh, as active managers, what are some of the things which go right? What are some of the things which don't go right? So, from your personal experience, you have been a seasoned investor. You would have taken hundreds of decisions with respect to investing into different companies. So, if you could give us one or two examples, if you would not want to take the name, that's fine, where your hypothesis would have played out really well and would have generated enormous wealth for you and your investors, and also one or two areas where your hypothesis didn't play out the way you would have anticipated.
Yeah, it's a great question, Harsh. See, first of all, I don't know if any of you followed a recent speech by Roger Federer, right? He's obviously one of the greatest players in men's tennis. And he said, I only won 54 points of percentage of the points I played. Just imagine one of the greatest tennis players ever only won 54% of the points he played. That means he lost 46% of the points. Our understanding is you are a good investor if you get 55% of your decisions right. You are a very good investor if you get 60% of your decisions right. And you are practically a genius or a god if you get 65% of right. So even if you are very good, you will get 40% of your decisions wrong. So I think being wrong is natural part of our business, right? Just like for Roger Federer, it's very normal to lose points, right? But the important first point is to correct your mistakes, right? It's not you get it wrong, you correct your mistakes. That's the most important thing. In terms of opportunities, what things have gone right, and let me talk about what has, let's say, worked out in White Oak. So in 2017, IT sector India, when we started White Oak, was looking as grim as what it's looking today, which is basically IT stocks had not been doing well. People had doubts on the existential of IT industry. That time the concern was digital, cloud and all. Now, of course, it's AI and of course H-1B visa and US recession, all those issues, different reasons. And till 17, for a long time, small cap and mid cap IT had underperformed large caps. So people always believe that will always continue. And we did a research and we realized that these companies today are very different from what the large caps, what they used to be a decade ago. So actually, we took a very oversized bet on small and mid cap IT in 2017 when IT itself was not doing well. And that's been one of our biggest alpha generators in the last 8 years. But that's in a very defined sector. Let me talk of very different new opportunity of late. So 5 years ago, we identified the early opportunity in EMS companies. And 2019, we invested in the first EMS company. I won't name the company, but it's today the largest market cap EMS company in India. The good part is we were also able to bet on the second EMS company in India, right, which IPO'd a few years ago, and got that also right. So we've been able to pick the right EMS companies, early trend where the stocks are up 10, 20 times in the last few years. That's on what has worked. Sometimes you have to disagree with the consensus. Sometimes you have to identify absolutely new opportunities in new industries. Both the processes are at work. Mistakes, there is no shortfall of mistakes. But people think of mistakes as things that you got wrong, where you put in money and lost money. I actually consider mistakes as not those where you actually bought in stock and lost money, a lot of money on them. See, mathematically, all a stock can do is can go to zero, right? The worst stock can go to zero. If you invested 100 rupees in a stock, the worst outcome for you can be that the 100 goes to zero. And by the way, I've had in my career experiences where something went down 90%, right? In the global financial crisis in 0809. But I think the biggest opportunities, the biggest mistakes are not investing in companies which you identified early, but they go up 10 or even 100 times. So I still remember in 2013, I've been tracking a cables company uh, since 2005. It's now been 20 years. In 2013, the stock price had come down to close to 10 rupees. Today, that stock is close more than 4,000 rupees as we speak, 400 times. I miss that story because, of course, 13 was looking very difficult. 10 plus inflation, 10-year bond at 10%, rupee was crashing. It looked like very difficult period. So the biggest mistakes are not, I always say, if you get a full toss, as a good batsman, you should be hitting the ball for a six. That day, the pitch is not an excuse. So I think the biggest mistakes are not participating in the big, multi-baggers that were in front of you.
Perfect. I think it resonated very well with us. And, Warren Buffett often says that, never bet against America. And I think to some extent, if we relate that, even the India of today is offering a lot of opportunities. And if we are sitting by the sidelines and not jumping into those opportunities or participating into those opportunities, then maybe the future generations will look at us and say that, you missed those things. So with this, we come toward the end of our discussion. And one piece of advice which you would want to leave our investors with.
Couple of pieces of advice. First is everybody needs to get a very competent personal financial advisor. This is no longer now DIY. This is a this is a very skilled job and also requires very strong behavioral management. There's a reason why people get trainers. While it's very simple to figure out what exercise to do on YouTube, but still people get trainers in gyms to get you the discipline, focus. Number two, I think everybody should spend at least 2 hours a month to educate themselves on personal finance. This will have a very large impact on your long-term well-being. So please spend some time to improve your understanding of personal finance.
So you mentioned 2 hours a month, right?
Yes.
Okay, I think that's very much doable because most of us spend much more time on a daily basis doom scrolling. So I think that's a very relevant and fair ask from our investors. So with this, we are at the end of our discussion and a very enriching discussion, I must say, and a few key takeaways for me. One which we often used to study in management school about first mover advantage, and you demystified that by saying that first mover advantage is quite overrated. Second, which a lot of us believe, including some of the analysts also, that investing is about differentiation, finding opportunities which no one is looking at. But your perspective was that it's about staying disciplined and not about differentiating. Third is very interesting example where you said that toss is important in a match, but can you do something about it? The answer is no. So focus on what you can do better. And example of Roger Federer, where 54% success rate ensured that he's one of the legends in tennis. We knew it, but reiterating that really helped us. And the last piece of advice, which I think I would want to carry home with, which we know, but sometimes, listening it again really helps us build that or cultivate that as a habit is eat well, sleep well, exercise, and live stress free. Thank you so much for your time and really appreciate. And I'm sure our investors would have a lot to learn from this. With this, we end our discussion. And before we end, I would want to wish your team and our viewers a very happy and prosperous Diwali.
First wishing all the viewers a very happy Diwali. And thank you, Harsh, and thank you, Megha. It's a pleasure speaking to you.